Hey everyone, Long Finance here. Welcome to the channel, where the mission is to seek out the best high-quality dividend stocks that offer safe, reliable, and growing passive income streams. If that is your goal too, make sure to join the community and subscribe to the channel. Today we will be seeking out the top dividend growth stocks with the highest expected future returns. This video will follow a similar approach as my last video about the 8 best dividend stocks for future returns. There's a link in the description if you would like to check out that video later. Let's jump right in. We are looking for the best dividend growth stocks from my July dividend growth stock watch list that will offer the best total return in the future. First, I'll show you guys the best stocks, and after I'll show you why this type of analysis can work. To estimate future returns, I will be combining analyst earnings forecasts with current valuation. Current valuation is based on dividend yield theory, and analyst forecasts were pulled from finviz.com. Here we go, all the data is in my spreadsheet now, and the results are in. The stock with the highest expected total return over the next 5 years is Northern Trust. They are forecasted to grow at 19.74% per year during this 5-year window. Not a bad return if you ask me. Lowe's clocks in a pretty close second place with a forecasted growth rate of 19.39%. Both stocks appear to be undervalued right now, which is boosting those future returns. MasterCard, Visa, and Charles Schwab make up the 5 highest future return stocks on the watch list. Each of these 3 stocks is currently overvalued, but the expected growth rate still looks very attractive, between 16 and 18% per year. Applied Materials also has an expected growth rate above 16%, even though the stock is potentially 50% overvalued right now. 8 additional stocks from the watchlist look to offer double-digit growth in the next 5 years. United Healthcare is forecasted to grow at 13.82%, Home Depot at 10.19%, Humana at 13.47%, T. Rowe Price at 11.71%, Jack Henry & Associates at 11.01%, Activision Blizzard at 12.67%, CDW at 10.31%, and Amphenol at 11.12%. The only troubling forecast is for Thermo Fisher Scientific, which due to its potential 30% overvaluation ends up with a negative growth forecast of about 0.5%. The average forecasted growth for all 30 stocks on the July watchlist is 10.35%. Okay, so now that we know which of the July dividend growth stocks are poised for the best returns, let's take a look back in history to see if there is any merit to higher earnings growth leading to better overall returns. I looked up the past 5-year earnings growth histories for each of the 30 stocks on my July dividend growth watch list. I found this data on finviz.com. I also pulled the 5-year annualized total returns for each of the stocks from Portfolio Visualizer. They are blacked out for now, but I'll show them to you later in the video. And what I want to do here is find out if companies that grew their earnings faster also offered better returns. All 30 of these companies had positive earnings growth during the past 5 years, and all but Viacom CBS also had positive total returns on an annualized basis. I have the table sorted by highest earnings growth, and I'll be breaking this data down into a few parts. First, let's see what the average earnings growth was. Taking the average of all 30 stocks, we come up with 18.84% as the average earnings growth. That's a pretty strong earnings growth rate. Let's see what the average annualized return for all 30 stocks was. Taking the average of all 30 stocks, we come up with 22.11%. That's a very strong average return. Using the rule of 72, a 22.11% annualized rate of return would mean you are doubling your investment every 3.25 years. So these 30 stocks collectively would have turned $10,000 into roughly $27,000 in 5 years. Let's get back on topic here. We are trying to see if we can find a correlation between earnings growth and total return. I'm going to look at 8 different combinations of stocks to see if there is a pattern here. I'll break the stocks up into the following buckets: the top 5 stocks by earning growth, the top 10, 15, and 20 stocks by earnings growth, and the bottom 5, 10, 15, and 20 stocks by earnings growth. Let's compute the average earnings growth for each bucket. Just like anticipated, the buckets are all increasing as we go from bottom to the top 5 stocks. If they weren't, there would be an error with one of the formulas. So let's see what type of returns each bucket would have generated. The bottom 5 stocks with the worst average earnings growth would have returned 11.59% per year, which isn't a bad return by no means. This return would be in line with the long-term S&P 500 return, but compared to the average return of 22.11%, it looks pretty weak. At 11.59%, it would take about 6.2 years to multiply your investment. Let's take a look at the bottom 10 stocks, and they would have returned 17.17%. That's much better and moving in the right direction. At this rate of return, it would take about 4.2 years to double your money. Let's take a look at the bottom 15 stocks, and they would have generated a return of 17.33%. So just slightly better than the bottom 10 stocks. But so far the returns are still increasing as we move up to higher average earnings. Let's look at the bottom 20 stocks now, and they would have returned 18.89%. That's a cool 1.5% more than the bottom 15 stocks, doubling your investment in about 3.8 years. The trend is still there, as each higher tier offers a better average return. Let's look at the top 20 stocks now, and they would have returned 24.94%, the first tier to offer a better than average rate of return. Of course, this is probably driven by the inclusion of stocks with the best historical earnings growth. At this rate of return, it takes about 2.9 years to double your money. Let's trim the list down to just the top 10 stocks now, and the average return is 26.91%. A nice almost 2% bump here. Through 6 tiers and the trend is still holding strong. At this rate of return, it takes about 2.7 years to double your investment. Let's take a look at the top 10 stocks, and they would have returned 29.31%, a 2.4% increase in return from the prior tier. This rate of return brings the time required to double your money down to just about 2.5 years. And finally, let's see what the top 5 stocks would have returned. And they returned a smashing 32.55%, which is a cool 10% more than the average return of all 30 stocks. Obviously, hindsight is 20/20, but nevertheless, we can see from this example that amongst these 30 companies, the ones that grew their earnings faster also rewarded investors with better total returns. This analysis doesn't work on an individual company basis, because as you can see, SS&C Technologies had the best historical earnings growth rate during the past 5 years, but returned only 17.21% per year, which is worse than the average annual return of all 30 stocks. So what we can take away from this example is that you want to diversify your portfolio to more than one stock, on the off chance that you don't end up picking the winner. Also keep in mind that I used forecasted earnings growth to make my expected return assumptions, and obviously those forecasts may or may not prove to be correct. Hopefully Wall Street analysts are right more than they are wrong, and their forecasts can lead to better returns. I'll be tracking how this forecast method works going forward, but it'll take a few months or even years to see if the method has merit. I know we are all confident that we are great stock pickers, but the truth is most of us are not. This is why I prefer a rule-based approach to investing. I look for patterns that have led to better than average returns in the past, and I try to apply them to a system that helps me pick dividend stocks to invest in. The 2 watch lists I cover monthly on my channel are built upon that system of stock selection, and I use them to make personal investment decisions in my portfolio. Let me know in the comments below if you have any questions, or if you'd like me to further explain anything in this video. Thank you for watching, don't forget to subscribe to the channel, and see you next time.